Part 1. The Illusion of Expectations. What if I told you, markets don't move because of economic data, they move because of expectations about that data? Welcome to the invisible layer of macro. In financial markets, price does not react to reality. It reacts to the difference between what was expected and what actually happens. And that difference is where money is made. For most retail investors, economic releases feel simple. CPI high, bad for stocks. Unemployment down, good for economy. GDP strong, bullish. But institutional money doesn't think in absolutes, it thinks in probabilities. Before any data is released, the market has already priced in a forecast. Analysts submit estimates, economists publish projections. Futures markets reflect rate expectations. Bond yields adjust ahead of time. By the time you read the headline, big capital has already positioned. This is why markets sometimes rise on bad news or fall on good news. Because what matters is not the data. It's the deviation from expectations. Let's break this down. Imagine inflation is expected to print at 3.0%. If CPI comes at 2.9%, that's lower than expected. Even if inflation is still high historically, the market reads it as cooling faster than forecast. Risk assets may rally. But if CPI prints at 3.2%, higher than expected, even though inflation is trending down overall, the surprise creates repricing. Bond yields spike, the dollar strengthens. Equities drop. The market is a forward-looking discounting machine. It doesn't trade today, it trades tomorrow's assumptions. Now let's connect this to rate expectations. The Federal Reserve does not operate in isolation. The market constantly adjusts the probability of future rate cuts or hikes. Fed funds futures move before the Fed moves. If investors believe inflation is cooling, they start pricing rate cuts. Bond yields fall. Financial conditions loosen. Risk assets begin to climb, sometimes months before the first actual rate cut. This is expectation leading reality, and sometimes the market moves too far ahead. When expectations overshoot, volatility increases. Because when reality fails to confirm the narrative, repricing becomes violent. Here's the critical concept. Economic data is backward-looking. Markets are forward-looking. CPI tells you what happened last month, but stocks trade what might happen next quarter. GDP confirms what already occurred, but bond yields react to how that affects future policy. This disconnect creates confusion for most participants. They react emotionally to headlines. Smart money reacts to positioning imbalance. If everyone expects a weak jobs report and it comes slightly stronger, that small surprise can trigger a major move. Why? Because positioning was leaning one way. When expectations cluster too heavily, the smallest deviation causes forced adjustments. Short covering, long liquidation. Volatility spikes. Markets are not linear, they are reflexive. Understanding expectations changes how you read macro. Instead of asking, is this data good or bad? Ask, what was the market expecting? And more importantly, how is positioning aligned? Because price does not respond to truth, it responds to surprise. In part 2, we'll go deeper. We'll analyze how this dynamic plays out in inflation cycles, rate expectations, and liquidity regimes, and why sometimes the market rallies even as the economy weakens. Because once you understand expectations versus reality, you begin to see the cycle before it becomes obvious. Part 2. When the market moves before the economy. Have you ever noticed something strange? Markets often bottom before recessions end, and they peak before the economy looks strong. That's not coincidence, that's expectation shifting ahead of reality. Let's examine a classic cycle. During an economic slowdown, data weakens, unemployment rises, corporate earnings fall, GDP contracts and headlines turn negative. But here's what most people miss. By the time the recession is officially declared, markets have already been falling for months. And when the recession feels the worst, markets often start rising. Why? Because expectations change first. Institutional capital tracks inflection points. They're not asking, is the economy bad? They're asking, is it getting less bad? That second derivative, the rate of change, matters more than the absolute level. Markets respond to acceleration and deceleration, not just direction. If inflation is high but slowing, bond markets react before CPI returns to target. If growth is weak but stabilizing, equities begin to price recovery before GDP turns positive. This is how forward discounting works. Price is essentially the present value of expected future cash flows. When expectations about those future flows shift, valuations shift immediately. Consider inflation in a tightening cycle. When inflation accelerates, the Fed raises rates. Markets initially sell off as discount rates rise. Liquidity tightens. Financial conditions become restrictive. But at some point, inflation peaks. Even if inflation remains elevated, the fact that it is no longer accelerating shifts expectations. The market begins pricing slower hikes. First-year. Eventually, future cuts. Bond yields often peak before the final rate hike. Equities may bottom before the first cut. This feels irrational to those focused only on present conditions, but it makes perfect sense in expectation-based pricing. Now let's bring liquidity into the discussion. Liquidity drives asset prices more than headlines. When central banks tighten aggressively, system liquidity contracts. Credit becomes more expensive. Risk appetite declines. But once markets anticipate policy easing, financial conditions begin to loosen before official action occurs. The dollar weakens, treasury yields soften, credit spreads stabilize, capital rotates into higher beta assets, all before the first rate cut. Because expectations have shifted, this transmission mechanism, from inflation data to rate expectations to bond yields to liquidity conditions to asset prices, happens faster than economic confirmation. This is why relying only on backward-looking economic data is dangerous. By the time GDP improves, the market may already be up 20%. By the time unemployment peaks, equities may have rallied for months. Economic reality lags price. Expectations lead it. However, this dynamic also creates traps. If markets prematurely expect easing but inflation reaccelerates, repricing becomes brutal. Bond yields spike unexpectedly. Equities drop sharply. Volatility surges. Risk assets reprice violently. Expectation misalignment equals instability. This cycle repeats across history. Tightening, pain, peak inflation, shift in expectations, recovery rally. Understanding where expectations are positioned within this cycle is more powerful than reacting to each data point individually. Macro is not about guessing numbers. It's about understanding narrative transitions. When the dominant narrative changes, capital flows change and price follows. In Part 3, we will connect this directly to Bitcoin, risk-on versus risk-off regimes, liquidity cycles, and how you can build a systematic framework. Because once you master expectations versus reality, you stop reacting and start anticipating. Part 3, building a framework around expectations. If markets move on expectations, then how do you measure expectations? That's the real edge. Because once you track expectations systematically, you stop being surprised, you stop reacting, and you start positioning. Step 1. Monitor rate expectations. The bond market speaks before policymakers do. Watch closely. 2-year Treasury yield, Fed funds futures, dollar index behavior, yield curve shifts. The 2-year yield reflects policy expectations more directly than headlines ever will. If short-term yields are falling while economic data is still weak, markets may already be pricing future easing. That's expectation divergence. If the yield curve begins steepening after inversion, it often signals transition. Not strength today, but anticipation of a new regime tomorrow. Step 2. Track liquidity direction. Liquidity expansion supports risk assets. Liquidity contraction pressures them. But liquidity is not just about official rate cuts. It includes balance sheet policy, treasury issuance, bank credit conditions, dollar strength. Even without formal easing, if financial conditions loosen, risk appetite can return. This is critical for assets like Bitcoin. Bitcoin is highly sensitive to global liquidity. It behaves less like a currency and more like a high beta liquidity instrument. When expectations shift toward easier policy, Bitcoin often moves aggressively, sometimes before equities, sometimes before rate cuts, because it reacts to liquidity impulse, not economic comfort. Step 3. Identify positioning extremes. Markets become unstable when consensus becomes one-sided. If consensus expects deep recession, rapid rate cuts, dollar collapse, but data stabilizes instead of deteriorating, markets may reverse sharply. Why? Because expectations were crowded. Crowded expectations create asymmetric risk. The bigger the consensus, the larger the potential squeeze. Short covering rallies, long liquidation cascades, volatility spikes. Expectation clustering amplifies movement. Now let's organize this into a simple framework. Layer 1, rates. Layer 2, liquidity. Layer 3, positioning. Rates influence liquidity. Liquidity influences risk appetite. Positioning determines magnitude of moves. If rates are peaking, liquidity stabilizing, and positioning defensive, upside asymmetry increases. If rates are rising unexpectedly, liquidity tightening and positioning complacent, downside asymmetry grows. Now let's connect this to risk on versus risk off. Risk on emerges when inflation expectations fall, rate expectations decline, liquidity stabilizes, dollar weakens. Risk off dominates when inflation surprises higher, rate expectations rise, yields spike, dollar strengthens. Notice. This is expectation-driven, not headline-driven. A systematic macro trader asks, where is the market positioned? What is already priced in? What scenario would cause maximum surprise? That last question is the key. Markets move hardest when reality invalidates consensus. This mindset transforms how you trade macro cycles. Instead of reacting to CPI emotionally, you evaluate deviation versus expectation. Instead of chasing rallies, you assess whether liquidity conditions justify continuation. Instead of fearing volatility, you understand its source. The final lesson is simple but powerful. Economic reality sets the stage. Expectations move the actors. If you only study reality, you arrive late. If you study expectations, you arrive early. And in markets, timing defines returns. Macro is not about predicting the future. It's about identifying when the crowd is wrong about the future. That's where asymmetric opportunity lives. And that is the difference between reacting to headlines and understanding the cycle. If you found this breakdown valuable, subscribe to Macro Cycle Lab. Because here we don't chase narratives, we decode them. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macro Cycle Lab. See you in the next video.